Hello traders, the title of the video is third step to mastering common price structures in the financial markets. So we have talked about the first step, the second step to mastering common price structures in the financial markets, and this is the third step to mastering common price structures in the financial markets. All right. So, talking about common price structures in the financial market, those are essential price structures that anyone that is involved with this financial market must know. It's not like may know or ought to know, but must know, because those are specific structures that the professional are monitoring, and you want to know how those structures develop, how they finish, how people trade them, what is happening, so you may master them. So please watch the first step, the second step, and also the second step to mastering common price structures in the financial market. You are day trader, swing trader, position trader, technical trader, investors, speculators, gamblers. You want to know the common price structures. All right. So what is the third common price structures? Very well often in the financial market, a financial instrument will start a trending. So you will start trending from here, go up all the way here, and the trend will end. Area way traders know how to pinpoint the end of a trend. If you don't know how the trend will end, all right, draw at least a channel. Sometimes it can become a bit complicated because the price can switch from one channel to another channel. So it makes it more difficult for ordinary technical traders to determine when the trend has ended. But generally, sometimes the trend will stay within one channel alone. It become easier. So if you pop out of that channel, then we know that the trend is about to end. But sometimes it can become a bit complex when the price is switching different channel. All right, but so the financial instrument started a trend and the trend has ended here. Now people start taking profit. This is correct. This is normal. So next time the financial market start going down, don't get too upset. Know that it's a harvest time. And this is normal, it's a market cycle. So people start taking profit, or the price start going down. So we remember, those who have watched part 1, we'll talk about okay, the 78.6% Fibonacci key level, how the price come down to that level. How do we trade it? We talk about it already. We will not talk about it anymore. For new traders, all we will say to them, go and watch the first step to mastering common price structures in the financial market. Then we also talk about the zone between the 50% and 61.8% Fibonacci retracement level. That's a second step to mastering common price structure in the financial market, how people trading, what is happening, so you understand everything clearly. But this time, the price will go down. Will not find a support between the 50 and the 61.8% level. Will not find a support at the 78.6% level. I will not find a support at the 100% Fibonacci retracement level. So I need to remind traders that when we are talking about the 100% Fibonacci retracement level, it means that the price return back to the starting point, forming what we call a cycle point. Yeah, this is a cycle point here. So at this point in time, generally, okay, some stock will find a support forming a double bottom here. This is another point where we will talk about it in another video. So after the 71.8% level, normally, if there is a future, okay, a viable future, okay, a bright future for that stock, they will stop selling it if the price reaches the cycle point. But for some stock, it doesn't happen. All right, this is what I want to talk about now. All right, so come to 100% level, will not find a support either to form that double bottom chart pattern. All right, then you continue to go down more. Where is it going? So now the trend has started here. People were happy to start the trend here. Everybody was happy to buy the stock up to this point. Now we're talking about harvest time, and the harvest time is becoming a bearish season. So normally a harvest time, by the time we reach 78%, there will be buyers, blah blah blah. 100% levels, we should have some people buying. Okay, so all the support level along the way, they probably did not find a support, a viable support. They probably may bounce up at those levels, but didn't find a viable support to start a new trend. That's what I meant. So we did not see a new trend from the zone between the 50%, 61.8% level. We did not have a new trend from the 78% level. We did not have a new trend from the 100% level. Where is it going? So it did below that 100% level, continue to go down. The next level is the 138.2% Fibonacci. Okay. Extension level, reverse. Remember that word, reverse. Okay, 138.2% Fibonacci extension level, reverse of the trending phase. So you may wonder, what are you talking about, George? Normally, here it is. What I meant by reverse is that, in fact, we are applying, so what you need to do is to apply Fibonacci retracement. That's why I'm using the word reverse. That's why I say, remember the word reverse. So you will apply Fibonacci retracement to your trending phase, you see. So this is how we draw Fibonacci retracement from the starting point to where the trend has ended. So we have all our Fibonacci retracement lines ready. So instead of paying attention to your Fibonacci retracement key level, you look down. Now this is what I call reverse. So now you see the extension are below that starting point. So that's what I meant by Fibonacci extension, reverse. It makes sense now? So you apply Fibonacci retracement, but you are not paying attention to the Fibonacci retracement. You pay attention to the extension below. It's a kind of Fibonacci extension that we are drawing upside down. Okay. So here it is. If you do it like that, you'll see that 138.2% is here. So that's a very, very important information for traders. So there was a trend. People start taking profit, but they continue to sell it even below the starting point. You need to know where the professional will try to buy it again. Where is the next key levels in the financial market that one must watch? For some stock, that level will go into the negative price zone. So remember this. If this point is a kind of 50 cent, all right, do you understand? 50 cent. All right, it's not going to go all the way to 138.2% because there's no room. We know we don't have a negative price. Just mentioning that. All right. So, by some stock, if they have enough room, the next level that the professional will watch is the 138.2% Fibonacci extension, reverse of a trending phase. And some stock, very often, they will do exactly that. They come to this point and then they start a new trend. Or some stock, they come to this point, they bounce up nicely. All right, so hold it a second. Here we are. So I want to talk about a real stock now, okay, because I don't want the video to be too long. Here it is. Suppose this is, I didn't find a good example now, but I want to show you this one. Just suppose that this is a trending phase. It's not a trending phase as such, but think of it as a trending phase. I will explain to you what has happened here, okay? Suppose. So I'll make that word clear so they don't bash me in the comment section. All right. Suppose this is a trending phase, okay? So this one we are trying. So when I from here to here. Here it comes. It start coming down. We say correction. We watch 50% and 61.8 zone. We see that bounce, blah, blah, blah. If it's not dynamic bullish financial instrument, it try to seek the next level, which is the 78.6% level. Bounce, is there a bounce, blah, blah, blah. Come to 100% level. Now we are at the 100% level. Okay. Here again, you see this bounce here. That's to acknowledge the 100% level bounce. But now here it is calm again and right below it. What is it going? You apply now Fibonacci retracement. Did I say retracement? Yes. to the trending phase. All right. And now instead of paying attention to the retracement, you look down below the starting point and you want to highlight which level? The 138.2% Fibonacci retracement level. Now, I need to mention to traders that are following us at the 2-4 Elliott Wave YouTube channel that I will be talking about it. Okay, I will be recording a video about this specific price structure, talking about Elliott Wave count. Some stock, all right, will start a new trend below, okay, the starting point of the prior trend at the 138.2% Fibonacci extension level. So what usually going through the mind of professional traders is that they sold it. The level of 138.2% Fibonacci extension reverse below the starting point of the prior trend is also considered as oversold zone, like we have the 78.6% Fibonacci retracement level. So we told traders that if a financial instrument has been trending before and is coming down, it reaches the 78.6% level, theoretically speaking, is considered as oversold. For Fibonacci traders, is considered as oversold. Okay, and now we will have to check Google Finance, perform our due diligence, and then we take it from there and look at the market itself first. Is the market turning from bearish to bullish? Is it time to buy? Is the market environment suitable? And so on and so on. Does the stock has a brighter future? What's going on? And so on. All right. But apart from the 78.6% Fibonacci retracement level, professional also watch the level of 138.2% Fibonacci extension reverse below the starting point of a prior trend. And this is here. Now, before you run away, all right, because traders do not have enough time, they want video to be very short, but for some subject I need to dwell on them a bit longer, so I end up being like 20 minutes, sometimes even 30 minutes, because of if you see a video, okay, that is long, you know that there are more we need to discuss. That's why it's long. But now, another thing I need to say to traders, okay, that are in the financial market is that sometimes this is what's happening. This is why this is I put in number 3. Normally I should put the 100% retracement level as the third step, but I choose this one for a reason, because it's so important, because it's another critical oversold level. Now, something else that you need to know. We talk about initial public offering. Have you ever heard that word? So if you're in the financial market, you know it. IPO is the initial public offering, when a company is being listed for the first time in the financial market. That's what we call initial public offering. So sometimes you may have initial public offering. They come into the market for the first time, they listed it, boom, in the market, all right? So the stock come in the market at $10, okay? People start buying, stock going up, everybody's happy. Look at this, remember this, my friend. All right, so it starts going up, everybody's happy, and then a few days later, no one is interested in the stock anymore. People start thinking that, oh, it was in fact now overbought, and everybody just give up on the stock. All right, and it starts coming down. If it goes below its initial offering price, all right, watch, calculate quickly, okay, that 138.2% Fibonacci extension reverse of the prior move up. Is it clear or not? So allow me to say again for traders who did not understand it, because some people can understand very fast, some people cannot. So allow me to talk to those people again. So the stock coming to the market, okay, the list is probably at $10. Everybody's happy, went up, come back, and then went up all the way here. Now, for one reason or another, after the initial public offering and this bullish move up, the stock start coming down. People start buying. People still buying, thinking that it's going to bounce out. It's not. It's going down. Now it come back even below the initial offering. All right. What you need to do, all right, is to calculate that 138.2% Fibonacci extension reverse of this move from here to here. The first move up after the initial public offering. You calculate that if there is room enough, you don't go into negative price. So usually stock that will come up at $40, all right, $30, and then they go up for a while, everybody's happy. And then a few months later, Keep it. You can go now and check stock that initial public offering stock that are listed recently, and check those who did exactly that, and you will see sometimes they go below their initial public offering. They become so cheap, and then here we are. Everybody's happy now to buy, and now the trend is beginning, and they start going up. All right, this is what's happening here. You see the stock here, it went up, and it came back below, and from there, from that point onward, look, from after it went below that level, here it is. Now, really understand what's happening in the financial market. In the financial market, that there are market participants that they call sophisticated market participants. Now, those market participants do care always at which price they are buying a stock. So something, remember, something that usually, suppose something that is, call it, $100, okay. Here it is now, $100. Now here it is at $62. All right, $62 at 38% discount nicely. You will be crazy not to buy it, yes or no? The true value of the asset is $100, and now here it is at $62. Are you out of your mind? All right, you will buy. So sometimes you see that. So initial public offering still goes up, and then a few years later, everybody forget of the initial offering. And then one day, that's why we want to know the initial public offering for some stock that recently listed, all right? And then you know it, so see it, all right? Let's see one example now. I will leave it that for now because I don't want the video to be too long. I'll talk about it in another video. And here it is. So this is why you want to remember. Some stock, though they will come down to that level, 138.2%, Fibonacci extension level, reverse or the prior trend, some stock will not go above the 100% level. So don't think that all stock that come to this point will definitely start trending and it will be all good for them forever. If they are not creating value, if they do not have excellent product, if they are not getting more market share, if they have a useless management in place, if the sector is not doing well, if the market environment is not good, what you will see is that the stock will start going down, and then as it reaches the 100% level, which is the cycle point, it will find a resistance. If they have a compassion on it, it will not go below this low here. So we will see a kind of a consolidation, blah, 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 below the 100% level before one day it will pop up above that 100% level. All right. Some stock, look at the scenario clearly. So don't think that it's all nice and beautiful all the time as it was here for this stock. Especially if you are a new trader, sometimes you will see it. All right. Again, what's happening? So you will see some stock, they will start to pop up from below here. So where is it going? It's going to the 78% Fibonacci retracement of this trending phase. You remember, it's a key level. So it goes above the 100% level. They want to bring it above the 78.6% level. You see here, this is 78. I don't use 78.6. I always use exactly 78%. 78% is not Fibonacci number. That's why I'm saying 78.6% level. But personally, I only use exactly 78%, and it works beautifully. So here it is, my 78% level. So here you will draw your line like this. So that 78% will be on your chart. Okay. You will have also the zone between this 50% and 61.8% is there. You are watching all those levels. As it finally come back above the 100% level, they will push it to the 78% level to test that level. We may see a reaction. I do not want to dwell on this because there are more to this. We can talk about Fibonacci patterns, but I will talk about it in another tutorial, talking about the mastering common price structures in the financial market. All right. So price will go up to the 78% Fibonacci retracement level. Try to retest it. Well, now even here you can see a bit of reaction. We have a bit of you see, that's a small tendency bar at 78% level. If you manage here, this is a very bullish stock. You can see it's a very bullish stock. It just went boom, 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 boom. No much of resistance here. You just break above it and retest it. Next level you must watch is what? Look carefully, my friend. The zone between the 50%, can you see how much? 50% and the 61.8% level. This is the zone. You see the reaction here. So he went into that zone. There was seller there. You try to sell. He formed that doji, that you see the tail of that candlestick bar in that zone. It's very bullish stock. This stock. You take it up. Now they bring it to almost. There is another level up here. I don't want to talk about it now. I will leave this one quietly here. All right, this one is usually I don't want to talk about it now. Okay, leave it there. All right, So we will mention that in another tutorial when we are talking about Fibonacci patterns. All right. So let's see how long I've been talking to you now. Okay, I've been talking to you 20 minutes. This is what I'm talking about. So remember this, the third step to mastering common price structure in the financial market. There was a trending first, then a correction begins. Price failed to find a support in the zone of 50%, 61.8% level. Also failed to find a support at the 78.6% level of the prior trend. And again, even at the cycle point, which is the 100% Fibonacci retracement level, it come back all to the starting point. Again, it failed to find a support. Where is it going? Is going to 138.2% Fibonacci extension level of the prior trend, reverse. Remember that well, reverse. Below it, all right? If that is the case, very often, the smart money will try to buy the discount, the stock, provided that they have a brighter future, the market environment is good, and most importantly, sometimes it's speculative buy. What do I mean by speculative buy? They want to give it a chance, okay? They think that they will come up one day. So some long-term investor as also speculative trader, they say, let's buy and hold this crazy company and see what come up. It's very, very oversold. It's becoming a penny stock. They want to give it a chance. But that's not the best way forward. That's a speculative buy. But sometimes they will go to Google Finance, they will do their due diligence, everything looks good, and new management is in place. Market share, they are getting more market share. It's looking brighter. At that point in time, at that level, they will buy and hold. As long as those first buyers that are big market players stay in put, the price has a high chance to start a new trend. And some stocks that are truly bullish now they dig into themselves and they start coming out with excellent profit for gaining more market share. And now here it is, a new trend is developing since 2003. It's still in place for this stock. All right, soon it will end somewhere here. I will talk about it to earlier wave traders. I took for earlier wave, it too will shut up. All right, so this is a good example when everything works well. Sometimes, some stock, as it starts finding a support here, you stuck below the 100% level, you may see a kind of consolidation. For some stock, if they break through it, even after the consolidation, if you break above the 100% level, the next level to watch is what? 78.6% level. Find a support above it. Here it is, you see. He ran above the 78.6% level, went almost to the top. Look what he did. He came back to that level again. Pull back to retest it. So draw that 78% level. He may find a resistance there. He may break above it. He may come back to it. Here it is. Before going up. So remember that structure. Once it goes above the 100% level, draw the 78.6% line. Draw the line between the 50% and 61.8% Fibonacci retracement level of the prior trend. You see here again, you see here. So break above retest. Look, it went up a bit. Look what he did. He pulled back to that zone, the sweet spot zone. That's what they call it also. The zone between the 50% and 61.8. Pull back again to retest it. Here he pulled back to retest which level? The 78% level. Professionals know that structure. They know it. That if a stock dip below the starting point of a prior trend, watch the reaction in the zone. Watch the reaction in the zone of 50%, 61.8% level. Price may come back and retest that sweet spot zone, even a retest in the 78% level. You also must know that common price structure like a pro and understand that some stock, if they are truly bullish, they will just going up like this. I would like to thank traders for their interaction for this series of video. I like it very much because I was very surprised. I really like this series of video about mastering price structures in the financial market. They see a lot of thumbs up, blah blah blah, comment, very good. So thank you so much. I like that very much as a YouTube creator. It helps us to know what traders are thinking, what do they like. So I will be recording, I think 2 more videos. We keep it 5. We'll talk about, the Fibonacci pattern and also the 100% retracement. So you may know, the essential common price structures in the financial market. It was not my intention to push the video too long, but here we are, 25 minutes gone. All right, so this is what's going on. Some video will be short, some video will be a little bit long, some video can even end up being 1 hour or more. Okay. As always, my friend, if you have any questions or suggestions, put it in the comment section. In due course, I will be recording another video to answer your specific question. If you find this video useful, all right, let us know by giving us the thumbs up. If you think that George, it has been a bit blah 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 today, I'm not very sure about this useless recording, mark it down. That will put us under pressure to come up with a better recording next time. If you think that this is an essential tutorial, do not hesitate to share it on Google+, on Twitter, and also on Facebook. This will conclude our discussion about the 3rd step to mastering common price structures in the financial markets. Happy trading to you all, and speak to you soon. We are the TSTW 24 traders.